Dan, my question would be around how most macro analysts are looking at this in general, right? You've been involved in the space for a long time and obviously looking at the macro side for a long time also. How have those conversations changed over the last decade with kind of what we'll call traditional macro investors?
Over the last decade, I thought you were going to ask over the last month or two with the discussion
Well,
about
yeah,
inflation.
maybe the last year is better.
Yeah, no, but I'll start with the first part. I mean, I would say that, look, the number of asymmetric opportunities in the 90s and 2000s, were enormous. I mean, you had all sorts of fundamental misalignments. The ERM crisis was one, or crisis. The big convergence trade in Europe was really, an exercise in understanding how politics can influence economics, but in the wrong way. And then at the end of the day, the fundamental macro, the economics ended up, in some cases prevailing, not in others. But you had these big fundamental misalignments. The same thing with the Asian crisis in '97. And of course, the big difference is that most of the macro guys, so all of the guys that by reputation, almost all of them made a substantial, I don't want to say all of their money, but certainly at least 70 to 80% of their money as a result of bond yields falling from their peak in the early 1980s. And so, if you start in 1991, 92, 93, the two-year note was yielding 8%. I mean, the Japanese two-year note was yielding, I don't even know now, certainly north of 5%. And so you had very easy bets to make. In a sense, you could borrow money in the repo markets overnight at a lower rate that you can invest in those two-year notes. And, basically some of those guys, they rode those two-year notes for 20 years, all the way to zero, and with almost infinite leverage, because when you buy bonds, the margin that you need to put down with your prime broker is practically zero. And so if you weren't a macro guy benefiting from that drop in interest rates, you were an equity guy who was benefiting from the drop in the expansion in the multiples that happen in the equity market, right? So in one sense, that entire macro game was based on that drop. And again, that was driven by an aberration really in the 70s, where we had this spiky inflation and they raised rates to, abnormal levels. And so we had a 25-year period, disinflationary period, where all the central bankers sort of, lived in fear. They're all fighting the last battle in a sense. So they kept policy very tight. In my view, interest rate policy was much tighter than it should have been for many, many years. And so, and again, that, culminated in some ways in the crisis in '08. And since '08, we've had permanently low yields because there's been too much debt accumulated in the system. And there, also the advent of, I would say, technology has been a permanent disinflationary force. And I think it'll be interesting going forward now, whether that reasserts itself. We've had spiky inflation because the money supplies have exploded post the COVID giveaway, which started in March of 20. I think it's going to be hard for them to pull it back. Very importantly, I would say going forward is, look, negative real interest rates are 7%. Okay, so the overnight rate is around zero and CPI is 7%. So that means the cash you hold in your bank is worth minus 7% a year. Okay, I think that it's going to take years and years for the Federal Reserve to bring on tight policy. Tight policy in my mind would be having the interest rate over the CPI rate. In March of 2000, the two-year note was 6% and the CPI was 3%, right? So that was 3% positive real yield in the two-year. That's tight policy. We're now completely the opposite way. So I actually am quite positive, medium term on the markets, on the traditional, let's just say the equity market. I don't really focus too much on the legacy world anymore. Very positive, of course, on Bitcoin, Ethereum, the digital asset ecosystem, all those new use cases, that whole world growing up. Very positive on that world. And, look, this whole discussion, and this is to your last part of your question about, the last few months in the Fed, the Fed just mentions that it's going to raise interest rates. And, we lose $15 trillion off the market cap of global stock markets. So in a sense, I think the stock market really already kind of tightened liquidity for the Fed. And I think as they, as they raise rates, look, in my mind as an investor, I don't make any differentiation between a 0 interest rate and a 1% interest rate, or even a 2% interest rate. So, and then, Pomp, I would wonder what your opinion is about this, but you look at the yields in the stablecoin market, you get 7-8% in the DAE on a stablecoin. What for goodness sake, what are you doing owning legacy world bond markets, $200 trillion of bonds in the legacy world, basically yielding less than 2% when you got a 7 to 9% yield in the stablecoin market?